Welcome to this week's episode of Jonathan on Money. This is episode number 149. Well, we're really getting into the heart of tax season now. This is actually my least favorite time of the year from a professional standpoint, with folks getting very nervous about getting their 1099s. Clients' unnecessary level of nervousness stresses me out. On the personal front, though, I'm getting pretty stoked about Purim. After all, Hamantashen are the best cookie ever recreated, and I challenge anyone to prove me wrong on that. Purim is also special in our family because it's the holiday where I met my wife, or more accurately, saw her from across the room and asked her a mutual friend, Wendy, to set us up. So thank you, Wendy. We celebrate this special occasion by making 50 shalach manot and then spending all day driving around town, giving them out, which is extremely romantic. In other news, here's a reminder about my new book, D is for Diversification, the ABCs of Personal Finance, which is available now on Amazon or on jonathanonmoney.com. And finally, before jumping into this week's episode, I just want to share that my upcoming live winter webinar will be on Thursday, February 26th at 8:30 a.m. featuring Evan Unzelman, CEO of CRT Experts LLC based in Leesburg, Virginia. And Evan's going to be discussing how to shift CRT benefits to children under today's tax rules. And I'll be sure to include the registration information in the show notes to this episode. Okay, now for today's agenda. My talking points this week will discuss retirement and falling rates and if you should be concerned about that. Our quote this week is from Charley Ellis on investing as a form of entertainment. I'll spend the last half of the episode answering listener questions, including financial advice for Travis Kelce and Taylor Swift on their engagement. And finally, we'll end with an actionable idea to implement your investing life, where we'll discuss ETFs versus index funds. With that, let's jump into this week's talking points. So I received the following question recently, and it went as follows. My brother-in-law is in the lending business, and at our family get-togethers, I heard him discussing how great it is that rates are falling. I understand that falling rates may be good for his business of lending money. It means more people will want to borrow if rates are lower. However, what about the average person like me who isn't looking to borrow money? I'm approaching retirement, have a decent nest egg, and I keep seeing my CD and money market yields fall. My question is whether I should be concerned with rates falling or as excited as my brother-in-law. And this question is timely since many soon-to-be retirees are in the same predicament. For context, the federal funds rate, which is the rate to which your brother-in-law is referring, is the lending rate that banks use when they borrow money from one another. This impacts credit card rates, mortgages, car loans, savings account yields, the borrowing costs, business pay, and more. In many ways, lower rates are positive for consumers. However, many investors may not see falling rates as positive given some of the impacts that you alluded to, namely lower yields on CDs and money market funds. Unfortunately, in order to compensate, many investors are tempted by options that promise higher yields and end up taking far more risk within their portfolios. And during every falling interest rate cycle, I've noticed investors making the same mistakes and missing out on certain opportunities. Investors who are aware of the financial options available to them will be best equipped to get through this part of the interest rate cycle unscathed and potentially even improve their financial situation. So here's some points to consider. And first, do refinance onerous debt. Lower interest rates make borrowing cheaper, so it may be a good time to refinance high interest debt such as mortgages, auto loans, or personal loans. This can significantly reduce monthly payments and the total interest paid over time. You can also consider consolidating multiple high interest rate debts like credit card balances into a single loan with more favorable rate. This will save money while also simplifying payments. Falling rates often stimulate the housing market as well. So if you're thinking about buying a home, lower mortgage rates can increase affordability. Keep in mind that while lower mortgage rates may make monthly payments lower, they also tend to cause real estate prices to go higher. Be sure to run the numbers so you are purchasing a home that is within your means. Next point is do have exposure to stocks. Lower borrowing costs for businesses can increase economic growth and boost corporate earnings, would generally benefit the stock market. It's important for all retirees to have proper exposure to the stock market. This is especially true when rates are falling, which may serve as a tailwind to this part of your portfolio. You should avoid reaching for yield. Over the past few years, investors have enjoyed putting their cash in money market funds and collecting attractive yields with virtually no risk. However, As rates come down, these risk-free rates will also fall. While searching for higher yielding investments, investors may subject their money to volatility and possibly the loss of principal. Focusing on the yield of an investment at the expense of other due diligence will have an unfortunate ripple effect on the rest of one's finances. Money that folks need for near term expenses or a rainy day fund should still sit in cash or cash equivalents despite a more modest yield. Next point is you should avoid pursuing lower quality credit. Investors may be enticed by lower quality credit to maintain a certain yield within their fixed income allocation. How unfortunately, that means investing in companies with shakier balance sheets. This may be fine for a small portion of one's portfolio. However, substituting most of your fixed income to obtain a higher yield is ill advised. As I frequently remind my clients, and risk and return are inextricably linked. I think I say that every episode. If you want higher yields in a low interest rate environment, you need to be willing to take more risk with your capital. It's important to keep in mind that the ultimate role of high quality bonds in one's portfolio is to serve as a ballast against more volatile equity positions. Once you invest lower quality companies, those diversification benefits and the margin of safety are gone. Another item is to avoid extending duration. Another way for investors to maintain a targeted yield within their portfolios by extending the duration on their fixed income holdings. In other words, instead of going out 1 or 2 years on the yield curve, they instead go out 2 decades or longer. The challenge is that duration is a measure of bonds' price sensitivity to interest rate changes expressed in years. Therefore, a bond with a higher duration is more sensitive to interest rate fluctuations. Its price will change more significantly for a given change in interest rates than the price of a lower duration bond. For example, a bond with a 10-year duration is expected to lose approximately 10% of its value if interest rates rise by 1%, whereas a short duration bond would be expected to lose only about 1% of its value. Granted, we are in a falling rate environment, but any unexpected change to interest rate policy can leave bond investments just as volatile as equities. Extending duration on your bonds leads to more portfolio volatility without the upside that equities provide. And finally, stay focused on what matters. To avoid common missteps in a falling rate environment, I encourage my clients to take a step back and look at the bigger picture. Instead of focusing on the Federal Reserve or what your brother in law is saying, investors should instead focus on factors that should always determine their portfolio allocation. This includes one's time horizon, risk tolerance, and goals. For example, if you need the funds within a few years, then using a savings account, money market fund, or short term CDs will always make sense regardless of the drop in yields. Investors should not risk the money they need for near term expenses to get a higher yield. If an investor is approaching retirement like you are, having some money in cash equivalents and high quality bonds for a couple years worth of expenses makes sense. However, it also makes sense to have exposure to stocks to grow your portfolio over time to combat inflation and help ensure that you don't outlive your funds. Where rates are and whether they'll drop further are immaterial to this reality. Staying focused on yourself and your goals instead of the latest headlines and what other people are doing is always the best approach when it comes to one's finances. Okay, those are the talking points this week. As a reminder, you can be notified of all my recent articles, webinars, and all the work I put out by subscribing to my free monthly newsletter at parkbridgewealth.com/newsletter. This week's quote is from Charley Ellis. For those who don't know, Charley Ellis is a highly respected investment thinker, best known for his work in indexing, investor behavior, and the importance of discipline and long-term strategy. He founded Greenwich Associates, a leading consulting firm to major financial institutions, and served for many years on the Yale University Investment Committee, which oversees one of the most successful endowments in the world. Ellis is also the author of several influential books, including Winning the Loser's Game, which argues that most investors hurt themselves by trying to outsmart the market and would be better served by low-cost, patient, rules-based investing, which his writing emphasized humility, process over predictions, and the idea that investing should be steady, almost boring, rather than exciting and dramatic. And Ellis once said, investing is not entertainment, it's a responsibility. And investing is not supposed to be fun or interesting. It's a continuous process like refining petroleum or manufacturing cookies, chemicals, or integrated circuits. If anything in the process is interesting, it's almost surely wrong. That's why benign neglect is, for most investors, the secret to long-term success. I like this quote because it draws a sharp line between real investing and entertainment-driven speculation. It reminds us that investing is serious, methodical responsibility, not a source of excitement. Real investing resembles a steady process that is repetitive, disciplined, and boring. Long-term success comes from patience, consistency, and constraint, not from chasing excitement. And that's why benign neglect, as Ellis calls it, is a sensible plan for leaving it alone. Works better for most investors than constant tinkering. Obviously, folks should actually not actually neglect their finances, but spending too much time obsessing over them, especially your portfolio, will lead to big mistakes. Okay, now let's jump into this week's financial questions. And if you do have a question, feel free to submit it to me, and it may be answered in a future episode. Okay, first question. I just retired, I'm sorry, and have around 4 million in assets. Nice. The challenge is I spend 400,000 a year on expenses. What investments can generate enough income to allow me to maintain my lifestyle for another 30 years or so? Hold up, brah. Do you have 4 million in liquid assets like stocks, bonds, and cash, or are some of these funds in illiquid assets like real estate, business ownership, or other illiquid assets? That will make the difference since you need these funds to finance your lifestyle, but let's assume it's all liquid. You have a spending rate of 10% of your portfolio, which needs to last 30 years. This is not a good situation to be in. You're spending too much money and have a high probability of outliving your funds. The solution to your predicament is not finding an investment that may generate a higher return, since that's impossible to predict. Rather, the answer is to modify your lifestyle. In plain English, this means spending less money. A rule of thumb is to spend no more than 4% of your portfolio if you first enter your retirement in your mid 60s. I think this rule is a bit too conservative, but nonetheless, it is a good number to strive for. If you get your spending rate down to the mid single digits, you will have a lower probability of running out of money and needing to get bailed out by another family member. I would suggest going through your expenses and cutting things out or minimizing how much you spend on the following areas: vacations, eating out, entertainment, housing expenses, streaming services, car leases, etc. You should be able to cut a few $1,000s a month of spending with ease. Then you'll have to make some sacrifices that will meaningfully impact your current lifestyle. I know this solution sounds unsophisticated and is probably not what you were hoping to hear because you seem to want to discuss investments and portfolio structuring, but to reiterate, investments are not the key to solving your problem. It's your spending that needs to be modified. Next question. Given the huge run up in international stocks, especially relative to US stocks, am I already too late to add it to my portfolio if I'm very heavily weighted in US stocks but have no international stock exposure? You shouldn't be timing when to go into various asset classes. Only amateur investors who don't know what they're doing try to time the market, as do equity strategists at large banks who are trying to make themselves sound sophisticated. The more sensible approach is to carve out a portion of your portfolio that's dedicated to international stock exposure. You should rebalance annually to maintain the allocation. Sometimes this international exposure will boost portfolio returns, and other times it will drag them down. The key is you are managing risk by having a more diversified portfolio. The weighting towards any asset class, including international stocks, will change when your time horizon goals and personal situation changes. So, I wouldn't worry about the recent run up. Instead, I would determine a sensible amount to invest in international equities and stick with it. Next question. What are your thoughts on Wyoming holding LLCs and moving brokerage investments into a business account for asset protection purposes? So this question is better addressed to an attorney who specializes in asset protection. That being said, I'm not overly familiar with Wyoming law. In general, I have seen Nevada and Alaska-based trusts be used for asset protection reasons quite often since their laws are favorable. In terms of moving a passive securities portfolio into a trust, this alone may not be able to justify the protection to the same degree as a real business. Also, depending who owns the LLC may also make a difference. For asset protection, some folks have their LLCs owned by different irrevocable trusts, what makes it harder to pierce. If you just owned LLC, that may provide some protection, but multi-tiered planning is likely much better. If you're going to be the only owner of the LLC, you may not get what is called charging order protection since multiple members are safer. If Wyoming law provides charging order protection for a single member LLC, I would still be concerned that other states like New York and New Jersey, where you conduct business, may not respect that. Big Wyoming may be a good but other state option, but good states are also good and have a longer track record of providing these protections. Yes, an LLC can provide protection, but the degree of protection will depend on a lot of factors, which I alluded to. Next question. I'm in the investment business and fairly sophisticated investor. If I have access to private equity deals with no fees since I'm investing along the GP, would you recommend a small allocation to my portfolio? I wouldn't recommend anything without having more information about your personal financial situation. The information you gave me is insufficient to give you specific guidance. I also have access to private equity and no fees where I can invest alongside the general partner or GP. Finally, I can do this, but I choose not to. Sure, the returns may outperform the stock market, they also may not. I also like more liquidity and don't want any headaches around tax time. Most importantly, I'm not convinced that it will help me achieve my goals, or I am certain that my portfolio, which is currently made up of stocks, bonds, and cash exposure, will allow me to achieve my goals. You should review your finances with a financial advisor who can see your whole picture and give you holistic advice if this type of investment makes sense. If this opportunity really sparks joy in your life and it's financially prudent to do so, a small allocation of 5% or less of your investable assets may be fine. If things work out, then great. If not, you won't lose your shirt. Forgive me for not being super excited about access to PE with less than normal fees. I've been in the business for 20 years. Excitement is not what increases investors' probability of success. Bringing it back to our quote this week, being boring and consistent does increase that probability. Okay, let's go to our next question. I don't like your assumption that a home only returns the rate of inflation. My feeling is that the return is far higher than that. How do you arrive at your low return assumption? So, what you feel and what is reality are two different things. I ain't your boyfriend's spouse or therapist. What you feel is immaterial to the situation. Now that I heard your immaterial feelings, let's review some data. So, the Case-Shiller Housing Index will give you broad country numbers on housing performance as well as the performance of certain large major cities. The S&P CoreLogic Case-Shiller U.S. National Home Price Index, a mouthful, but it began in 1987 and has delivered an annualized return of approximately 4.5 to 5% over its full history. This reflects long-term appreciation in U.S. single-family home prices, excluding new construction and condos. Be mindful, these numbers don't factor the cost of owning a home. When taking those expenses into account, you may keep up with inflation. Sure, your community may have experienced different returns, but I have found when you run the numbers and actually factor in expenses, you are still only keeping up with inflation. The reason why your feelings aren't in line with reality is because a home is a very emotional financial asset. Many memories have been created there. Simchas, Yuntifs, watching the Super Bowl, Yankee and Rifki's engagement party, little Shmulek was toilet trained on the first floor bathroom, birthday parties, you built your suck on the patio outside for 20 years, and many other glorious occasions. All these things are wonderful and memorable, but won't increase your rate of return. Contrary to what many homeowners believe, strong emotional attachment will not increase your performance numbers. Okay, next question. My company was just acquired by a larger firm. I can roll over my old 401k and I have about 1.5 million that I can either move to the new company 401k or an IRA. What should I do? There are pros and cons to moving funds to your new 401k versus an IRA. The pros of moving it to a 401k are you can borrow funds from a 401k but not an IRA. Although borrowing funds from a retirement account is a suboptimal financial decision, but it is helpful if you are in a jam. The cost of a 401k may be cheaper than an IRA with a financial advisor if you work at a very large national company. However, if your company is not large, the new 401k provider may have higher fees compared to your financial advisor. You will need to do due diligence to determine these numbers. Another pro is you can make backdoor Roth IRA contributions without triggering the unfavorable tax due to the pro rata rules than had your money been an IRA. Finally, in some states, a 401k may offer additional asset protection compared to an IRA, although very few people are compelled by this last point because they feel an IRA has adequate asset protection qualities. The pros to moving it to an IRA are more investment options, where a 401k is very limited and you are forced to use their often mediocre investment selections. You'll keep your funds consolidated with your own advisor, who can advise you holistically on all your assets. Another is with the 401k, you're paying a fee, even if it's a modest one, and get nothing in return. No investment or financial planning advice, no flexibility with investments, etc. No one actually cares if your funds are invested appropriately. This can end up being a very expensive mistake. Imagine working for decades and having your funds allocated inappropriately to unsuitable or mediocre investments. Another benefit is it's more seamless to make Roth IRA conversions if desired. It's worth discussing your situation with a financial advisor to determine what makes the most sense for you and your specific situation. Next question. What financial advice would you give to Travis Kelce and Taylor Swift on their recent engagement? Two words: prenuptial agreement. This can help protect their respective businesses and professional lives in case things go south. Conversely, if Travis falls into a funk now that his football career is over and blows his money and develops gambling debts, this will protect Taylor's business from his imprudent behavior. This separation of their previous businesses, careers, finances is sensible. On the other hand, after the chasana, it would be beneficial for them to combine some finances to pay for their life together. They are both relatively young, and the whole concept of Travis paying for certain things and Taylor paying for others makes it feel a shtickle like they're not on the same team. They should have a joint account with joint money going into it to pay for their lives together. Travis and Taylor should think of themselves as a single team, one band, a single goof. This mindset is important to any marriage. I wish the chassan and kala much bracha, hatzlacha, and only good things for both in ruchnius and in gashmius. Amen. Selah va'ed. They talk about investing a 401k in private equity and private credit options. You've taught me that private equity is typically riskier and less transparent. So, I guess my question is whether this is worthwhile to incorporate into my retirement plan. Thank you for teaching us. It probably is not appropriate. The first, who is they? The talking heads on TV? Your broke brother-in-law who doesn't know anything? The big macher at shul who's living on credit card debt? Don't worry about the they. They are broke, uninformed, or selling nourishkeit. Let's focus on you. So, lending money outside of traditional banking channels, more eloquently referred to as private credit by asset managers looking to sell their products, isn't all it's cracked up to be. It's either as safe as an investment grade bond. I should say, it's neither as safe as investment grade bonds nor as diversified as publicly traded high yield debt. Returns may be more muted than those public equities, and its diversification benefits are questionable. Furthermore, this asset class is illiquid and its ongoing tax liability is unfavorable. Finally, investors have the privilege of paying a large premium compared to traditional investing for access to these products. Most retail investors would be better off just sticking to a portfolio of stocks, bonds, and cash and steer clear of opaque asset classes like private credit, especially within their 401k. Until that point, you should avoid private credit or reserve a small percentage of your portfolio to allocate to this area so you can sound like a big macher to your friends at the Kiddish Club while not revealing the small size of your position. Small sizing of such an asset class can assure the benefits from the Kiddish Club chit chat without derailing your financial life. Next question. I see my advisor has been using closed-end funds for the bond portion of my portfolio. What's the difference between a regular mutual fund, and does this make sense? Your advisor doesn't know what the heck they're doing. The bond portion of one's portfolio is primarily for safety and it serves as a ballast to the rest of the more volatile equity portion of one's portfolio. This helps keep one's emotions in check, mitigates volatility, leads to rebalancing opportunities, and keeps some of the investment dollars secure in case you're in a tough situation. You need to liquidate funds. The issue with closed-end funds is a bunch, but let's list them. One, price volatility. Because they trade on exchanges unlike open-end funds, closed-end funds can swing significantly, sometimes diverging sharply from their net asset value. Two, leverage risk. While leverage can amplify gains, it also magnifies losses during downturns. Three, limited liquidity. Some closed-end funds trade infrequently, which can make it harder to buy or sell at desired prices. Four, complex pricing. Investors must evaluate both the underlying assets and the market sentiment driving premiums and discounts. Number five is IPO premium trap. Closed-end funds often launch at a premium to NAV and then fall to a discount, making IPOs a risky entry point. If you don't understand what this means, let me say it clearly. Your closed-end funds will plummet in price after buying it. A regular mutual fund is typically far less volatile, doesn't use leverage, has more liquidity, is easy to price, doesn't trade on the secondary market, and won't plummet right after it becomes available to investors, or likely will not. You should use bond open-end mutual funds for your fixed income exposure. Anyone who's trying to convince you otherwise is a charlatan, scumbag, an ignoramus, and should be put in Cherem. Okay, that's it for financial questions this week. And by the way, if you have a more involved personal finance situation, feel free to reach out directly to me. Perhaps my team and I can help you. The best way to get a hold of me is via email at jonathan@parkbridgewealth.com. And finally, I'd like to end with a timely and actionable idea that listeners can implement to their financial lives. And today's timely ideas regarding ETFs versus index funds. So, ETFs and index funds are both popular for passive investing, but when it comes to tax efficiency, ETFs generally have a slight edge. One reason is due to the in kind redemption mechanism. ETFs use a unique process called in kind redemptions, which large blocks of shares called creation units are exchanged for the underlying securities. This avoids triggering capital gains taxes for the fund itself. Additionally, it's uncommon for ETFs to distribute capital gains to shareholders. This means investors usually only face taxes when they sell their shares, not while holding them. On the other hand, when investors redeem shares from a mutual fund, the fund may need to sell securities to raise cash, which can trigger capital gains and are passed on to all shareholders, even those who didn't sell. It's also not all about taxes. Be mindful that the dividend reinvestment is typically more seamless with mutual funds. Index funds often offer automatic dividend reinvestments without fees, which can be more convenient than ETFs, where reinvestment might incur brokerage commissions unless your broker offers it for free. Another advantage to index fund is that they only trade at the end of the day and not every second of the day like a stock or ETF. This is an advantage, so your emotions don't cause you to see wild fluctuations minute to minute, which may cause you to make rash decisions. You are not a logical investor and don't have your emotions in check despite what you believe. This one's daily liquidity will be helpful to you and most other unsophisticated investors. The liquidity with ETFs may lead to imprudent behavior. All that being said, we are really getting to the weeds with this question. As I often like to remind folks, big picture decisions are far more important than obsessing over relatively minor details. Index funds and ETFs are both superb options if you choose the right product for your portfolio and weight them prudently. And with that, it's a wrap for this week's show. Any comments or questions, feel free to reach out directly to me via email. I love hearing from my listeners. And finally, the secret to financial success is no secret at all. It's to spend less than you make, invest the difference prudently, and ignore all the noise. See you next time on Jonathan on Money.